Good morning, gang. Happy Halloween. Spooky, scary, crazy stuff. So, all right. So, if you want to start with some of the spooky stuff, we could get into the uh, solar flares CME that's supposed to hit, well, I guess starting last night and into this morning or whatever. That I guess you could potentially see the auroras all the way down to just north of me, about the Kentucky-Tennessee border. And I guess there are warnings right now for anywhere above the 50th parallel, which is a little bit north of the United States and Canada. The Canadian-American border is the 49th parallel, so a little bit north of that into Canada, that they could have problems with communications, with power outages, anything like that for the way this is hitting. So, yeah, it'd be a little spooky, but if you get a chance to see any of this aurora or whatever it would be, maybe it was last night and we didn't see it. I'm not going to see anything here because it's been pouring rain for 3 days nonstop. So the only thing I'm seeing is ducks. On to the scary stuff. And I'll kind of explain this again, and yes, this is me getting wonky again with you guys. If you heard what's going on in the bond market, and I know I talk about the bond market occasionally, we are now entering a period of an inverted yield curve. Now, to explain what that is to you guys real quick, the 20-year bond is now paying a higher interest rate than the 30-year bond. Now, traditionally, the longer out you go, the more interest you get paid. You guys know this from buying CDs, from buying whatever you would be, okay? Because you're taking more risk. I mean, in that case, you've got an extra 10 years of risk, and who knows what's going to happen, all right? When the yield curve inverts, what that is an excellent signal that we're about to hit a recession. Because what you are seeing is bondholders, companies, governments, etc., seeing more risk in the near term than they are in the long term. Now, right now, it's the 20 over the 30, which is both long-term debt instruments. So we're going to keep an eye, and this is where I say watch the 10-year, going above 175. We're at about 156. It's backed off a little bit from the 170 it was at earlier last week. But, we've got to pay attention because the 20-year sitting around 2%, the 10-year sitting at 1.56, thereabouts, or whatever it is. If that starts to invert, that means we're starting to really get some near-term worrisome ideas. So what does that mean for you? Well, if you've got an adjustable rate mortgage, if you've got an adjustable rate mortgage, your mortgage payments are going up. All right. Hopefully, after 2008, 2009, everybody learned not to get an adjustable rate mortgage. If you have one, work on refinancing that into a fixed rate immediately. And I got to think not a whole lot of people have them anymore. If you have credit cards, and credit cards, for the most part, are adjustable rate interest rates. Pay off that credit card debt, guys. Get rid of it because the interest rates are going to go up on the credit cards, which means more of your monthly payments are going to go toward interest and less toward principal, which just means that you're going to have longer to pay it off. Y'all know what I've said a million times: do whatever you can to get yourself out of debt, especially something like the credit card debt that you're paying 25% interest on or whatever it is. Still, please get rid of that stuff. It also means more inflationary pressures. And if you caught what Janet Yellen said on Friday, she still sees inflation as transitory, as temporary. But she doesn't see it getting fixed until the third or the fourth quarter of 2022. Okay. I'm sorry, but in my opinion, temporary inflation is not 18 months worth of it. That's pretty much permanent. Temporary, be a month or two, a couple of months, maybe a quarter, okay? Not a year and a half. So you're still going to see prices continue to go up. Plan accordingly. All right, get what you can now. Get out of debt. Buy whatever you need now because nothing's getting cheaper. All right, we all know that. I'm not telling you guys anything you don't know. Stock market. This is where it gets real scary. All right, and I know people ask me, it's like, what should I do with my 401k, whatever. I can't answer that, guys, okay? Because if you're 20, if you're 30, if you're 50, if you're 70, it's different for everybody, okay? And it depends on your risk tolerances, the whole 9 yards. I'm still going to go out and say we are going to see a market crash this year. And yes, I know at this point we have 2 months left, all right? But there are plenty of pundits who still see that we could see a 60% slide in the market this year. There's only 2 months left, guys, all right? The inverted yield curve is a signal that the market is in trouble. What's propping the market up, y'all know as well as I do, it's speculation. The market is not trading on its fundamentals anymore. The market usually should trade on the expectations of a company being more profitable. You're buying something that makes $1 now and you're going to invest hoping they make $2 and you can make money off of it. That's basically the idea of the stock market. What we have now is a whole bunch of amateurs in there who are throwing darts at a newspaper going, oh, gee, I'll pick this stock. I mean, I'll give you this as a perfect example. I think it was either Thursday or Friday. Facebook changed its name to Meta, right? M-E-T-A. And instantly there was a company, I want to say they were Canadian or whatever it is, but traded on the New York Stock Exchange, that went up 60% because people were buying the wrong stock. Okay, they thought that was the stock symbol for it. There's an exchange traded fund, META. Okay, that's its symbol, Meta. Okay, went up like 30% right off the get-go because people are putting money into the stock market, not even knowing what the ticker symbol is, and just buying stuff, okay? This is how silly the stock market is, guys. And I'm going to say the same thing I've said for a year, and I know there's going to be a ton of you said, you told me to get out last year, and, I didn't tell anybody to do anything. I'm just telling you what I did. The market went up. Okay, sure. Did I leave money on the table because the market went up? Yes. What did I use the money for? I paid it on my house. Okay, I didn't use the money to go on vacation or something like that. If you use the money to pay off debt, good, all right? That guaranteed yourself a return. Maybe it wasn't the highest return. Maybe you could have made more money if you were in the stock market. Maybe you could have made money if you bought Bitcoin at 29,000 and it's 60,000 or something like that now. Sure. Nobody can time the market perfectly. Anybody that tells you that the timing the market is a fool's errand, okay? It's your risk tolerance. It's like, okay, have I made enough? The old saying in the market, pigs get fat and hogs get slaughtered, all right? If you made some money and you're comfortable with it, move out and don't look back. Don't go, oh my God, if I would only stayed, buyer's remorse or seller's remorse, FOMO, fear of missing out, okay? Guys, when you're thinking about, this is my retirement money, I can't afford to lose it. If you can't afford to lose it, you can't afford to take risk. That's basically where you are with this. And the risk we have in the market now with an inverted yield curve is significantly higher than it was a week ago, a month ago, a year ago. All right. This is where, like I said at the top, a inverted yield curve is a excellent indicator that a recession is on the horizon. We all remember the recession from 2008, 2009. Look back. If you want to go through that again, okay, that was practice. This is reality, okay? You remember what happened then, and you look back and go, what could I have done better? That's what you need to be doing now. Happy Halloween. Don't mean to be too scary. Have a good one. Pinball out.